Good morning and welcome to today's Ideas for Your ISA webinar. I'm Ryan Lightfoot-Amanoff, and it is my pleasure to host the ever-popular Richard Staveley today, manager of the Rockwood Strategic Investment Trust, which focuses on some of the smallest stocks in the UK, the microcaps. Now, for those of you who are new to our events, firstly, welcome. It's a pleasure to have you as always. We will be sticking with our usual format today, which will involve a short presentation from Richard, which will last around 30 minutes, before handing back to some Q&A from the audience for around 15 minutes. Now, if anyone would like to pose a question to the manager, please make use of the Q&A box in the bottom right of the screen. We will collate these together and put them to Richard at the end of the presentation. And that is plenty enough from me. The main event is Richard, so I'll hand over to him, and please take it away.
Thank you very much, Ryan, and thank you all for your interest in Rockwood Strategic and UK small caps. Let's face it, the industry stats are that most people are shunning the sector, the geography, and the market at the moment. So I do really appreciate the fact that you're prepared to listen to what I have to say today. The plan for the presentation is a quick reminder. I do this at every presentation because there will be new people of how we go about things, but I'll do it this is the shortest overall style presentation, so I'll do it as quickly as I can without rushing it. And then we'll touch on the performance and the market opportunity, and then we'll get into the portfolio, where I've got quite a lot of stuff and detail on the components of the portfolio, and we talk about a number of the holdings. So thank you very much. Let's get cracking. So just a quick disclaimer, just to say that stocks go up and down, and not to take this is advice. But you all know that already. So the executive summary is as follows. So Rockwood is a specialist investment trust. We're now about 160 million market cap. We believe we're very differentiated from the mainstream smaller companies funds. And we think the strategy is proven. I was appointed lead manager of the strategy in late 2019. And we think this part of the market, the bottom end of UK small caps, is very inefficient. Lots of opportunities for mispricing. We're targeting stocks that can double over 3 to 5 year holding periods. We may end up holding them for longer, but the idea at outset is to look 3 to 5 years into the future and work out whether we think the shares can double over that period. If they do it over 5, we'll get our 15% IRRs, and that's essentially the gross performance target before costs for the portfolio. We are self-declared value investors. It really matters to us. You'll see that in the companies that we talk about in the portfolio. And we run a concentrated portfolio. So there are currently 25 positions, but the majority of the capital's in the top 10. I think it's about 63-64% at the moment. And finally, we're not only active in as much as we take a lot of active risk because we have a concentrated portfolio, i.e. versus any kind of benchmark that a normal small cap manager might be considering. We also are active investors, so we get engaged with the businesses that we invest in to varying degrees, depending on the requirement to unlock shareholder value or catalyze change in the businesses for the better. I run the fund from Harwood, which was founded by the veteran investor Christopher Mills, who himself, with Nick Mills, has a couple of investment trusts, and he also has a number of other strategies run from 6 Stratton Street, our offices. He has the private equity team on their 6th fund that focuses primarily on UK smaller businesses, but also some in North America. We have a global equities team now, who are the ex-Artemis guys, and we have private credit as well. And there's various inputs there. It's quite a mutually beneficial building to work in, where everyone's sort of trying to find great stock ideas. This is the only thing I do, so I don't run any other strategies, nor do I have any managerial or commercial requirements. It's just Rockwood Strategic for me, and both Harwood and myself are fully aligned with shareholders. I own just under 1% of the business, meaning of Rockwood, and Christopher Mills has got about 15%. Both of us had higher percentage amounts before, but we've been diluted through the issuance that we've been doing now for nearly 3 years, growing the fund. I've added throughout that period. It's been a little bit difficult to pick up. The fund's grown from below £40 million 3 years ago to 160, as I mentioned. The performance, this is slightly old now, actually. We'll be refreshing this at the end of this quarter. But to the end of last year, we'd had a sort of relatively solid year versus for the 12-month period that was to the end of 2025. But solid, or in fact, actually best in class 3-year and 5-year numbers, and I think 4 years and 6-year numbers. We don't have those as well. And you can see we've been delivering in a variety of markets. As for most recent performance, you'll probably all be aware, as much as I am slightly irritated by what Trump's done in Iran and its impact on markets. We were trading up at 305 a couple of weeks ago, which would have been up about 7% year to date. We're now down a couple of percent. So it's been quite a move back in the last sort of 10 days. We've been through this before. I was actually considering it. It seems to be a Q1 problem. If you look through the years, we had Liberation Day last Q1. We had Silicon Valley Bank and Credit Suisse the previous year. We had the Ukraine invasion from Russia was Q1. COVID was Q1. And I guess the point being is that these big macro events, have been at a high, clearly at quite a high tempo in recent years. But just look at the performance record, despite all of that, and also despite a lot of people's views sort of anti the asset class of UK small companies during that period. And I think that just plays to the truth, which is our approach is very differentiated and less affected over time by these events. The very long term for small caps is Belter. It's obviously an extremely long time series here, 71 years, run by the London Business School back to 1955. And the reason I have this in is it just highlights the size effect, which does seemingly work over any sort of decent holding period. And clearly, £1,000 invested in 1955 would have compounded up to 1.9 million quid if you'd been invested in large cap. But if you'd been in med cap, you'd have made 5.6 million. In the bottom 10% of the market, where most UK smaller companies funds fish, you'd have made 11 million. But if you focused on the bottom 2% of the market, you'd have made over 29 million quid. I've keep reiterating this because this is where we're looking. We're looking at smaller market caps than the mainstream UK smaller companies funds. Obviously, there's been this exodus. You keep reading about the outflows out of UK equities, but I think there is some scope for optimism. The pension fund allocations now, after a sort of couple of decades of selling, basically can't get any worse. It's down to kind of, I think the domestic industry on average is now underweight UK equities as a proportion of global markets. They obviously did quite well last year, and some of them will be ruining their underweight if they have if they're assessed on that basis. So I think that's sort of playing out from the main DB defined benefit schemes has kind of played out. Interest rates have been gradually falling. Now, clearly, the Iran conflict has sort of kiboshed the short-term direction of interest rates. I myself was expecting at the start of this year a cut in March, but clearly that will have been put on hold, I would imagine, That said, the underlying UK economy and inflationary impulse is definitely down, and we'll just have to see how long the Iranian issues last for. It's not great for the asset class overall, but if they can finish, and I'd hope that Trump, clearly, I think most people are hoping that he does move on to something new. He seems to tend to do that relatively rather than have sort of sticking point on certain things. We should see some alleviation, and then I would expect inflation to continue to drop in the UK, Xing out the oil price effects, and the MPC be able to continue to reduce interest rates, which will be positive for UK small caps. Clearly, the government you'll all have your own views, but it's fair to say that the clarity provided at the end of last year was much better than that the prior year with regards to potential additional fiscal contractions. So I think she's given herself, Mrs. Reeves, enough headroom for now for that concern to leave. And actually, prior to Iran, it did feel like confidence was building quite strongly actually in the UK, and some of the survey evidence suggested that. We'll just have to see. What is the case? I apologize, I've stolen the top left chart from River Global Investors. Actually, a business, it used to be called River Mercantile, and I was a co-founder of it literally in 2006. Hugh Sargent, who works there, brilliant fund manager, and I were messaging yesterday with the news that River Global is being acquired by Lion Trust. It's actually 20 years exactly since Hugh and I resigned from Société Générale Asset Management to start River Mercantile, so they don't mind me stealing their charts. But this one just shows, it's interesting, it shows the previous drawdowns of small cap versus large cap performance since 1990, the various different cycles. And I want to draw your attention to the red one, which is this one, which basically shows that, you know, as yet it hasn't recovered, but in all other lines you can see the small versus large performance does eventually pull back and get you back up to par. So I think that's worth pointing out. With regards to valuations, we're off the bottom. This is the top right chart. This is the Schiller 8-year PE for the numerous smaller companies index. You know, that's clearly off the bottom and still in the cheap territory, definitely not the expensive territory where the US stock market is currently. And I think that bottom right chart just shows you just the FTSE 250 relative to the FTSE 100. We don't have any stocks in the FTSE 250, but it's got pretty good data. So I think that's quite an honest chart about relative size valuation differences in the UK market currently. So as regards Rockwood, we have a significant universe. I was checking the stats. It's pretty sad, really. So last year, we call them deaths in the fund management world. There were 126 deaths in the UK. That's companies taken over, gone bust, delisted, run away to America or whatever last year. And there were only 26 births, of which I think about 16 were on AIM, and some of those were slightly odd, very small kind of shells and things like that. So the market has been shrinking, but there are still hundreds and hundreds of stocks for investors that invest lower down the market cap scale to invest from. I think our total universe is probably still about 700, 800 stocks. It used to be about 1,000. It's definitely not that anymore. And that's fine when you're creating a portfolio of just 25 holdings. We just need to pick the very best from that quite large universe. Our mindset is differentiated. So I believe one of the other presenters on this series was the Rights and Issues Fund, you know, who are not recovery type investors, and more sort of quality growth. And indeed, that sort of quality growth mindset, it's the more common mindset within UK smaller companies. So we tend to look at situations differently than the average small cap manager. We do a lot of due diligence, and because we've got a smaller portfolio, it gives us the time to do that. And we believe that that creates an information advantage over other investors and generally the market, being professionals full-time on looking at these companies. And they're often the smaller end ones where there's limited broker coverage, but a lot of information actually out there, which, I mean, we obviously utilize AI, but in other sources of data and information about businesses, their competitors and stuff, you can find a lot of information these days if you put the time in. We also think that our engaged approach does enhance investment outcomes, and I'll give you a few examples of things we've been up to recently in a moment. So what are we trying to do? First of all, we are buying proven businesses. So we're not buying kind of pre-profitability, unproven kind of products, or we're not doing biotech. We don't do people trying to explore for resources. We have this free cash flow focus, which is sort of sits behind our value mindset. We're interested in mean reversion. So we're looking for companies whose profitability was high or higher, has collapsed or fallen materially, and where that profitability can mean revert back up to the average level of profitability or the profitability of peers in the future. We look at mean reversion though also through a balance sheet, where a balance sheet maybe was good, now is bad, could get better again if sorted out, and indeed valuation, where valuation used to be sensible or fair for the type of business it is, but now is low, and we think that can mean revert as well. All of those problems for a recovery situation clearly need some form of change. So the key onus on us is to identify what needs to change. Is it the strategy, the operational effectiveness, the management themselves, or potentially parts of the board? And then what we do is we kind of engage with shareholders to kind of help or accelerate those changes. Occasionally, I'd say probably about 25% of the ideas, maybe a third of them, are ones where the change is actually already happening, but because of people's behavioural biases or just lack of interest or just ignoring or whatever, we can buy them anyway without there needing to be a huge amount of engagement from us, and that they're less hard work than the others. But we'll do both. And we also develop an exit thesis, which is to kind of mitigate the illiquidity of a number of these holdings when the thesis is played through. So we're trying to work out what we're going to do, how we get out of the stock at the end of it. We're typically buying big stakes, so we need to get liquidity. So we look carefully into who might be the trade, strategic or financial buyers of a business at the outset. Very briefly, some of you have heard this a few times, so I apologize, but we do think that this style of investing is permanent. It's not arbitrageable. It is just human behavior that you see again and again and again in companies and even sports teams in a slightly different way. But basically, there's bad M&A, or there's some sort of strategic error that the management and board sign off on, or the management just become tired or complacent or lazy or just aren't very good in a good business, the new appointees. And that leads to this period of depressed profits. That typically leads itself to depressed valuation, often financial stress, and clearly a highly emotional backdrop for all the stakeholders, board, management, and shareholders, and the dominant narrative is negative. That's the interesting point. That's when we're looking at when we're due diligencing and trying to work out whether it's a value trap or whether these things can be sorted out. So what emerges from that is what we think is the value creation or realization strategy, what needs to happen to either replace or enhance both or either or of the management and board. An operational plan needs to be developed by the new management in order to deliver on the improved profitability. We establish in our minds what the target returns should be for the business. Often, but not always, the balance sheet needs stabilising as part of that process. It'll either be through fundraising or through improved free cash flow generation as a result of the better profitability. And after that's all played through, you get through to the point where everyone goes, oh, everything's fine now, and the ratings normalised and the returns have improved, and everyone's sort of comfortable talking about the stock more widely. So onto our top 10 holdings. A mix of businesses here. Some of you will have heard of some of these, some of you won't. It's quite a range of industries. What I can say, because we've literally just had the kind of updates from every single one of these companies in the last 8 weeks, is that RM and Restore, RM and Trifast were sort of basically in line, so those were solid results. Capita had inline results, but given a disappointing outlook, and I'll come back to that in a moment. And every single one of the other top 10 holdings has had outstanding results and getting upgrades and beating expectations. And that is kind of quite rare in portfolio management. So I'm just really delighted with the situation in the top 10. If you take RM, our largest holding, being in line is fine. The big key catalyst there is them getting on with the disposal of their 2 divisions that they've now publicly stated they will dispose of, or are looking to dispose of and find strategic options for. We've long engaged with them about doing that. That's what they're up to now. Hopefully we'll get that news soon. That will pay down the debt at RM, which is still at a high level, and should unlock the valuation in the remaining division, which is the world leader it's a world leading platform in the allowing the assessment of exams and marking exams. They have contracts like with sort of International Baccalaureate, Cambridge Assessment, Institute of Chartered Accountants, but the results were solid. It looks like that key division was growing really well. We think they're building a lot of value there, and fingers crossed we could get news hopefully pretty soon that they've exited 1 or 2 of those divisions. Capita, it's been really quite painful in the short term. We're still in profit on the investment. There's a big multi-year turnaround happening at Capita, and the results demonstrate significant progress. There's no doubt about that, across a range of things that need to happen in the business. The key piece of information that's the status which we believe is being kind of overlooked by the market right now is that the core public sector division, which is where they run a range of contracts into the public sector, from everything from the student loan company in terms of how it's administrated, GP back office, the ULED zone, the congestion charge, TV license, Royal Navy recruitment, you name it, all these sorts of things. That division is actually doing really well. It's making kind of 8% margins now, high cash conversion. They've got it back to growth. Well over £1 billion of sales in that business, and we think that division alone is worth £1 billion. We think that's quite conservative expectation, and as you can see, the market cap's 400. The business has had some real problem contracts that the management team, the new management team, inherited. They exited those in December. That's really positive. But the reason why it's been weak in the last sort of 8 or 9 days was their contact centre division exposed to the private sector is proving quite difficult to turn around. Some real challenges in that, despite the huge cost cutting they've done already. And as a result, they kind of guided down guidance overall for the year, which during a period where risk off has been sort of the first thing people have been thinking first thing in the morning, has gone down pretty badly. We think they've been hit by that reaction so far, and I would point people who may have missed it to the fact that Oasis have announced in the last sort of 36 hours that they have increased their stake in the business to 14.5%. For those that don't know Oasis, obviously we're an engaged investor, but Capita's quite a big business, so we've got over 3% of the equity. We're a major shareholder. Oasis, though, have run extremely successful activist campaigns and been very strong at identifying value in the UK stock market. They did this with Premier Foods and Restaurant Group, Kia, and we think that they pretty much can see the opportunity that we see in the company as well. And I'm pretty sure that we are going to make a very substantial return in capital in the medium term, notwithstanding the fact that it's a bit disappointing they've had to temper the outlook in 2026. This is a more, I just used the logos here to try and just group up. I've said dreams are for dreams because you'll get lots of fund managers coming in trying to sell you a story or a narrative about, you know, things that sound exciting, and it's all quite generalistic. And I just don't think that's the right way of approaching investment. But these are definitive sort of categories to try and help you understand how I think about the portfolio itself. So with catalysts pending, I've just mentioned RMs. It's the sale of those divisions to pay off the debt. James Fisher and Sons, I'd set this chart, this slide is a few months old. James Fisher's about upgrades. We've just had the upgrades, we've just had the results. There will be more upgrades. They still haven't upgraded it enough, and that's now starting, and that's really working, and that is catalyzing James Fisher shares, which just hit a 52-week high yesterday. Mercer Asset Management is a business that owns, according to them, £125 million of balance sheet investments in private companies, which they've promised to sell, and they haven't sold any yet. When they do sell those businesses, the market will be able to value the fund management business which they've built up, which has over 2 billion under management and is highly profitable, appropriately. And we think that will unlock a doubling in the share price at Mercia. Net cash, it's doing buybacks with some of that cash. We engaged with them about that. Kooth is ridiculous. I'll come back to it in a moment. And I've just talked about Capita. We've made some recent investments. This is in the last sort of 4 or 5 months. Just to remember, we're not like the mainstream funds that are buying 10 stocks a quarter. We typically buy between sort of 2 and 5 companies a year. These are the most recent ones. I'll talk about maybe in Q&A about Videndum, where we're about to participate in the refinancing of that business, which we're very, very excited about. And then I've done a special news slide for you all on Big 26 in a moment. Just wheeling forward to realization on the far right. So what's happening here? So realization is we have sort of 3 phases in our investments. Stabilization, which is when it's all still a bit messy, the changes need to be made. You still get kind of changes to the numbers, downgrades, finance director needs to go. It's still quite the most riskiest phase when we first invest in the business. Then we have the delivery phase where the new team are delivering on that mean reversion of profitability. And then we have the realization phase where, in our view, the stock's kind of done what it can do. It's fair value, and we want to realize our investment. Sentinel Media, you'll see 3 down on that far right, was one that was in realization phase during 2025. And I think it's next week, actually, we get paid, or they're returning all the money back to us. So for those that don't know us, Sentinel Media, we own 29% of the business. I myself was on the board as a non-executive director. I came off the board to enable Martin Rowlands, who we proposed to come back to come onto the board to be chairman. And Martin has then broken up Sentinel Media, sold off the various businesses. We've got one very small one left. And he started that process at 22p. And he's returning money at 48p next week. Chesterfield Special Cylinders, I came onto the board to help refinance them. They're now a business in net cash. They've got results coming up shortly, so I really can't talk about that to anyone today. But that has now revalued materially over the last couple of years for those that are following the stock. And Vanel is one we've also owned for just over 5 years now, where we feel that the value inherent in the business needs to be realized for investors. They're trading at a deep discount to book value, and the book value are piling and foundation rigs exposed to construction and infrastructure markets in the UK. Shares of 36p, book value is about 50p. And the one I wanted to mention was M&C Saatchi, because for those Sunday Times and Times readers, you may have seen we got a little bit of coverage about what we may or may not be up to there. But Saatchi's, you'll all know the name, Maurice and Charles. Only one of the brothers is still on the register, and they're not involved in the business, haven't been for some time. It's a very, very interesting now collection of services within media. Its advertising agency is a modest proportion of profitability now. So for those of you thinking it's an agency like a WPP or a S4, it's just not. In fact, nearly half the profitability is from a division called World Services, which is strategic communications advice to governments about how they communicate globally. And they have contracts there in the US with NATO, with the UK governments, Australia, the UN. And that is a high margin and very stable activity. They also do, they also have a sort of sports, they call it passions, but sort of sports and entertainment, sponsorship style business, which isn't, creative agency. They have a consulting, business. They have a performance marketing business, which was actually bid for and rejected quite rightly by the board before Christmas from another small cap for 50 million. Anyway, we think that the long and short of it is we think that the sum of the parts, the various businesses are worth considerably more than the current share price. The business has net cash, unlike Mr. Sorrell's business or WPP. There's no balance sheet problems at all at MC Saatchi. In fact, they've recently just started a buyback program, so excess cash flows coming back to shareholders. We've been engaging heavily with the other shareholders at MC Saatchi and with the board in a constructive manner. And for those that can see, the CEO, who hasn't been there particularly long, is stepping down. And there have been two new board directors appointed. Vin Murray, who also is one of the stakeholders, and Nick Schott, who is extremely experienced and veteran M&A operator, ran Lazard's investment banking in London, and has done a number of media transactions. And we think all the things are coming in place now for significant uplift at Saatchi's. I spend the time mentioning it because it's on a sub 10 price earnings ratio. It's net cash. We think that the World Services division is worth more than the entire current market cap, and it's over 5% of our portfolio. So it will make a difference to Rockwood over the next year or so. That column was big 26 expected. Just three of those, and I'm just lighting on these because I do think, in particularly the first two, where I've done a little table for you, just gets a sense of the style of investing that we're doing. So in these, both Funding Circle and Vanquis, we were sort of buying them in late 23, early 2024, and you can see the 20 outcomes for 2024 really terrible in both companies' businesses. Although I think they've just got into profit. In Funding Circle, you can see then for both businesses a very material change in profitability in the year just past. And then you can also see a very significant growth in profitability coming through in 26. So that's why we've got them in that column, big 26 expected. We think that quite a lot of investors are only just waking up to what's going on in both Funding Circle and Vanquis in terms of their profit potential of both businesses. And the reason why we know they're not waking up was because if we're right about what 2027 may have in store, which is only a year away, they're on P's of five times. You can see the balance sheet, obviously net cash at Funding Circle and at Vanquis, a strong capital ratio. Just very briefly, the key thing that is happening here, Funding Circle has basically spent well over 100 million creating a best-in-class platform, which is just absolutely backed by billions of data points, where they've been running it for 15 years, loads and loads of loan data, where they facilitate the lending to small British businesses, the florists, the dry cleaners, the popcorn makers, proper little businesses, the salt of the earth. The SMEs is interesting. The SMEs are nearly, I think they're nearly 50% of the UK economy, almost 45% of the UK economy. And the mainstream banks now SME lending is only 2% of their books. It's slightly outrageous in my opinion, but from funding circle, it's great because they can pick the best ones or the best credits, and they facilitate people that want to lend into that market where they can collect it. It's very quick to apply for a loan. You get an answer relatively quickly. And the point is that they've now grown to a size where that activity is covering all the costs of running the platform. And guess what? Any further growth is very, very incrementally profitable. And that's why these profits are going up very, very fast. That's obviously a very valuable thing, a platform. And platform businesses are on very high multiples, not 5 times. Vanquis used to be the old Provident Financial, and which also got itself in a massive mess, as the 24 PBT shows. But again, it's massively on the turn under a brilliant new management team who have been sorting it out, cost cutting, addressing massive underinvestment in technology, and getting on the front foot with their lending. And you can see again, it's on 0.5 of book. Just finally, a comment on Filtronic. I'm nearly there because I know we want to get into Q&A. Just finally, Filtronic, this has become more popular. It's a stock that quite a few people have heard of now. But if you haven't, it's a IT hardware maker, so not something AI can resolve. And their hardware allows the receipt, transmission, amplification of radio signals, which are used in defense applications like the nose cone radar and the Typhoon, I understand, and also in space, their largest client being SpaceX for their Starlink satellite network, where they've been winning. They've got a strategic alliance with SpaceX. Actually bought 15% or have under option 15% of Filtronic as part of that alliance, and where that network is becoming the dominant network so far, but the first mover of what will be probably a number of other satellite networks around the globe. And they are in great shape as basically the only provider. It's a bit small in that bottom blue box, but they basically are the world leader, and no one else can do what they do on certain wavelengths. So we're very excited there will be significant contracts this year from that. Ryan's come on to hurry me up, so I'll just say a couple of things just very quickly. Our core holdings, the ones where we're the most engaged, I think I just draw your eye to really just the second column, which shows you the types of stakes we're taking, very unlike traditional fund managers. This means we have real influence on the outcomes. We can really make sure they're focused on shareholder value. And these are the springboard opportunities, which are the smaller or have been the smaller holdings of the fund. The only one I was just going to mention briefly in passing was Kooth, which is our mental health provider, digital mental health provider. It is a ludicrous share price now. They're 105 this morning. That's 39 million market cap. They told us in January that they have 21.5 million pounds of cash, and that they are profitable, and that they have won another US state, and that the California contract, which they have, is going really well. I really do think it's a ludicrous share price, Kooth, at the moment. So to conclude, Ryan, value bias, small cap bias, markets depressed. What a buying opportunity. In fact, actually, for ISAs, for the ISA season, what better than to have a bit of a drawdown as a result of Iran to exploit the guns than UK small cap. We're doing this, we've proven it over the long term. We're doing these kind of buy stocks that can double. We're active, we ignore the benchmarks, and we're really aligned with shareholders. So there we go.
Thank you very much. As you'd expect, we had a few questions come in, so we'll crack on with Q&A. We'll actually touch on your last comment, that there has been a little bit of volatility around both the share price and NAV. And that has meant there have been occasional days where the trust is trading at a discount, whereas previously traded at a premium, being able to issue shares. Are you concerned about this at all, or is it just short-term volatility?
I'll be silly to say I wasn't concerned, just as sort of the way the humans process information. But I think what happens is, because we do a weekly NAV, and the NAV is moving around with markets being a bit volatile. The price can move around. It's always, in fact, if anything, I've been quite comforted that we've been very close to NAV on all these days since Iran started. I mean, it's only been very slight. It's been quite accurately tracking the kind of theoretical NAV, which people have to work out, or the market makers have to work out for themselves. So it feels to me as if we're kind of holding steady on the around about NAV. So I think that's the case. There's quite a lot of, we know there's quite a lot of people, including some of the larger people that have come on to register, are looking to build positions in the trust. So we're hoping that that will start to occur shortly as well.
Thank you. And while we're on the the topic of defence, you've got a defence holding in there, which I believe is Pennant. That hasn't risen as many peers have, especially the larger cap holdings. What do you think the reason is behind that?
Yeah, so just as a quick preamble, our defence exposure, James Fisher has a load of defence, Filtronic has a lot of defence, and then I don't think anything, it's just those, well, Capita has a bit through things like Royal Navy, but that's our defence exposure within the fund. So with regards to Pennant, I think this is all about, I mean, it's not micro cap, Ryan, it's nano cap. So Pennant is literally, market cap's about £10 million. They've had there's been a big board kind of renewal over the last, I would call it sort of 18 months under a new chair, and including a new finance director. They've had some really, because of their lack of scale, they've had quite lumpy contract profiles for the business, and that's been quite difficult to manage market expectations, number one, but also cash. The cash position in the portfolio, which is linked to kind of how some of the big contracts pay. There's no doubt, though, that the opportunity set for Pennant remains very significant for its existing businesses. We'd like to see them scale to become a much bigger business. We'd be supportive of management to do that if they could find an appropriate acquisition to do. And we've done the same thing recently with Flowtech Fluid Power, which we also think will get a much higher rating if it scales in size. But I think Pennant's it's just too small, and the records to date has been just too volatile for people to really kind of get involved in, particularly institutional managers. It's just too small at the moment until they come and ask people for money. I do understand, I believe the VCTs have been looking at it, though. It's VCTable, so I think VCT funds have been looking at it of late.
Interesting, thank you. So I'll ask one question on sort of the broader market, and then we'll go back to the portfolio questions. Do you think that the AIM market has a future, or will it eventually just be merged into the all share? I quite like it. So many of you will know Gervais Williams. I suggested this idea to Gervais the other day, and he doesn't like the London Stock Exchange. I don't think he'd mind me saying this, but I said, look, why don't we just merge AIM with Main, repopulate the main market, have the small cap market as the bottom of the main market. The arbitrage between the rules between AIM and Main aren't that different now. It's much narrower than they used to be. Why don't we just do that? You could kite mark. I know when I used to play rugby, we used to have our studs checked for kite marks, in case we sort of got the illegal ones. We could sort of kite mark everything on AIM in terms of to retain its tax status. So whilst it remains on, and they could sort of review it for any people trying to do something dodgy, because bound to be a couple of them will try and do something weird later with it. But you grandfather everything on tax status, and then you probably align a new tax rule around size on the main market, and then you're off, and then we just got one market. That to me sounds sort of quite sensible. I think that if overall sentiment to UK flows turns positive, you will actually get a pickup in AIM listings, and you might see an improvement in the AIM market. But it's difficult to be bullish about it at the moment. That said, we see a huge amount of value in the hundreds of businesses that there are on it. So about, just for those that don't know, it's not, we've got quite a lot of main list stuff. So RM, James Fisher,
Capita, Treat, Funding Circle, Vanquis. There's a few, STV. Quite a few like main listed stocks in our portfolio. So there are some other smaller small cap funds which are very exposed to AIM. We're probably more like about half.
Okay, thank you. Now, just a couple of those names that you have got sort of ongoing dialogue with. Can you just sort of talk through your activist approach, why that might differ from what our listeners might think of as activism when they've seen the activism going on directed at the investment trust industry, and then also how the wider team at Harwood fits within that?
Yes, okay. So first of all, we start in a constructive manner. So we want to be constructively engaged with the boards and management teams, the business. So if we're seeing something that needs changing, either at the outset or later on, if they've disappointed us where we didn't have something yet, and we decide we want to change, we will be constructive. We'll go to management and board. We'll make the effort, meet with them, and say, look, these things, we believe for these reasons X, Y, and Z needs to happen, or X needs to go, or X and Y needs to go. And if those arguments make sense, then typically, they'll sort of take it on board and maybe hopefully thinking it for themselves already, but they're just not getting on with it as quickly as they may feel they need to. And we might just accelerate the change. In order to make change that's a bit more sort of controversial or whatever, and obviously just everyone hates changes generally, you really need to know that you're going to more people will support that sort of change. So part of our engagement involves us reaching out to other shareholders and saying the same thing. So we reach out to, having spoken to the board or management, we'll reach out to the other shareholders and say, look, we think these things. What do you think? And they might say, well, we think the same as you, Richard. But they may not have the time, effort, energy, or kind of passion to sort of see it through, or sort of want to sort of see it through. So we can then start engaging at the next level with these management teams to say, look, we've spoken to everybody and everyone agrees this is a good idea to do. So why aren't you doing it? And then eventually, if we have over 5% stake in a business, which you saw, we've got over 5% in. I think now we've actually got over 5% in Harwood, having 18 of the 25 Rockwood holdings. We could call an EGM if we feel that people are just not listening to common sense, and that we think we'll win the EGM because we think other shareholders will do that. Although it rarely gets to that, because once they know that we've got the votes to call an EGM, they typically fold and get on with it in the end. Harwood crossover in 6 of the Rockwood holdings. We want some Venn diagram of coverage between the two of us, but not 100%. Otherwise, it gets confusing for investors what funds they should invest in. But in that regard, depending on the nature of who's made the investment or who's best suited, either Christopher or myself or Nick Mills will lead the engagement with the underlying company. We also, the influence is 2 levels. So there's like this taking the stake, and then there's actually influencing the membership of the board. So there's 2 ways that happens. There's actually ones where it's officially they are a Harwood board appointee, and where clearly not non-independent, but we would, in order for this sort of circle of life to work, we have to sort of work in all shareholders' interests. Otherwise, they don't want us to go on the board and help sort things out. So we work on behalf of all interests who we think are aligned with us. There's a few of those like that. So, for instance, Nick Mills is on the TriFast board. I mentioned I was on Centaur and I've been on Chesterfield, but also we have. We will propose candidates to go onto the board. Christopher's forced this more than me during his much longer career. Said, right, these guys have to go on the board. Often we'll just propose, and then through a proper due process, they happen to end up being selected. That's the case, for instance, recently with M&C Saatchi. But also, if you take Titan Jamie Brooke, who's a member of the investment advisory group at Rockwood, is chairman. We made chairman of Titan. He's also on the board at Flowtech Fluid Power. So I think it's actually now up to 11. So 11 of our 25 holdings, it's someone we know very well is on the board in one capacity or not. Is that answered the question? I'll just check if that has it.
I believe, yes, thank you. And I think we might need to bring Q&A to an end at that point. We have run a little bit over time, but that's fine. I just don't want to keep our audience away from their lunchtime sandwiches. It just leaves me to say, Richard, thank you very much for your time. We really appreciate it. And also to all of our audience, we've had amazing participation so far. So thank you to all of you for sticking around for the extra few minutes as well. Have a great day, whatever you're up to. If you would like to watch the webinar again, a recording will be available in the next couple of days. And then also more information on Rockwood, including results analysis and a full review of the trust, is available on the KTI website. Thank you very much. Goodbye.